All right, welcome everyone to another free webinar brought to you by optionslam.com. Get through the legality CFTC rule. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment, nor do we provide financial advice, nor do we make investment recommendations. These webinars are for educational purposes only, etc., etc. Please read and understand the disclaimer. By participating in this webinar, you imply agreement and understanding of our disclaimers. I am Marko, and this is my email address, optionslam.com@gmail.com. That's easy to remember, optionslam.com@gmail.com. Please go ahead and email. You know, a lot of people use the contact us button from the website, and you can do that. All that does is sends an email to me at this address. So you can use that. The reason we don't publish our email address on the website is like most, many websites don't do that because it just helps to prevent and slow down the spam emails that we get. If we publish our email address on the website, our spam rate goes up tremendously. So instead, we just put out the feedback contact us button, and that really prevents a great majority of the spam. Okay, so optionslam.com@gmail.com. All right, it has a name. It has a name now. The single-winged iron condor, or SWIC for short. How about that, folks? How about that? Because if you think about it, that's exactly what it is. It is an iron condor, but it's only got 3 legs, so it can't be a real iron condor, because a real iron condor has 4 legs. Let's get into it. We started this topic out a few weeks back in the webinar series called Exploiting IV Crush. In that webinar, we identified quite a few strategies that do just that. That is, exploit IV crush upon a stock's earnings announcement. Some of the examples of strategies that take advantage of IV crush are selling credit spreads, okay? Iron condors, the real iron condors, naked strangles, selling naked strangles, selling puts, selling calls. All of these things exploit IV crush. Even some long butterflies can be examples of strategies that benefit from IV crush. In the last webinar, we identified a strategy without a name, but has since been given one. It is now the SWIC, or single-winged iron condor. The single-winged iron condor is a combination of 2 of the aforementioned strategies. The SWIC sells a naked put, and simultaneously, it sells a call credit spread. Combined, both of these strategies benefit from IV crush, but combined and done the right way, we get a boost in IV crush, exploitation, and a super high probability trade setup. Let's review the concepts. By the close of the first trading day after an earnings event, after a stock releases its earnings announcement, approximately 80% of stocks move less than their implied move. Okay? On that 1 day move after an earnings event, most stocks stay within their implied move. Day one. Now, some stocks have legs and the move can get extended. Other stocks, that move gets faded. Options experience IV crush. Okay, so this is the next concept. Options do experience implied volatility crush. Options on a company stock begin to deteriorate in value immediately after the company releases its earnings report. Is this always true? Almost always. It's pretty rare that you'll see implied volatility stay stagnant after the earnings comes out, or possibly go up. Pretty rare. I can't think of a time where I've seen it, although I'm sure it's happened, but it's got to be extremely rare. Once the news is out, premiums deteriorate due to IV crush, implied volatility crush. Designing a strategy that can profit whether it goes up, whether the stock goes up, goes sideways, or goes down with limits, that is, provides the trader with a high potential for a winning trade. Designed properly, this trade has a typical win rate probability of over 90%. Let me say that another way. Designed properly, the probability of this trade being a winner, theoretical probability based on options math, which we all know is very accurate, it's uncanny how accurate options predict market movements. The likelihood of a winning trade is over 90%. Now, can a trader screw that up? Yes. And I'm going to show you some examples of trades that had opportunities for locking in profit, but if the trader gets greedy and doesn't take the profit when it's available, can that trade, a winning trade, turn into a loser? We all know that can happen, right? From personal experience. Oh yeah, Marko's guilty too. The single wing iron condor setup. Discover the implied move weekly and the implied move monthly at optionslam.com. We'll walk through this a little later on in the webinar. We'll actually go through and we'll set this up for some trades. There's quite a few opportunities this week to put this trade on. Okay, quite a few good opportunities that I see coming up. So we'll get into that. Model the trades in analyzing software as follows. Now, I use thinkorswim. Some of you may not have access to thinkorswim, so you'll have to seek out another analytical type of a software that can do that for you if you don't have access to thinkorswim. And there's many out there. I guess I should make a list and of all those softwares. If you know of a software that does a good job of analyzing, why don't you shoot me an email, and I'll compile those and make a list of all the softwares that you provide to me. Please send me an email. Okay. Sell an out of the money put at or near the implied move. This is the setup. Okay. So you figure out what the implied move is. That's available right at optionslam.com, or you can calculate it yourself from an options chain, looking at the money straddle, the price of the at the money straddle. That's what we use. Sell an out of the money put at or near the implied move. Sell an out of the money call credit spread, whose short leg is out of the money at or near the implied move. Okay, so what we were selling, think of it this way. We're going to sell a put and we're going to sell a call. So now what we have is a strangle, but we're going to protect the upside in case of an overshoot by buying a call further out of the money. So that's the call credit spread, right? Short a 100 call, long a 105, that would be a call credit spread, right? To create a trade that cannot lose money to a bullish move in the underlying, the total credit must be equal to or greater than the width of the call strike spread. Okay, so in my example of the 100 short call, the 105 long call, that call credit spread is 5 points wide, right? But we sell that, and we also sold that out of the money put. The total collected premium must be wider than that 5 point spread of the 100 to 105. So we need to collect $5.01 or $5.10 or something greater than $5 to eliminate any risk of losing money to the upside. That's what gives this trade such a high probability of winning. I'll show you and analyze in Thinkorswim here as we move along. Let's talk about where the max profit is and the break evens. Then we'll be getting into some examples. Max profit is achieved at options expiration when the stock price is between the short strikes. Now, I'm not going to suggest that you want to hold this trade all the way to options expiration. And I'm not suggesting that you don't. You need to manage each trade individually based on your own personal level of risk tolerance. Okay? Break even is when the stock price at options expiration is at the put strike price minus the credit received. Okay, so let's see if we can rephrase that. If you hold the trade all the way to options expiration, the break-even price of the underlying stock is at the put strike minus the credit you received. So if you sold the 90 put as part of this three-legged strategy that we call the SWIC or single-winged iron condor, if you sell the 90 put and you collect $5.10 for the entire three-legged trade, your break even is $90 minus $5.10. So the stock can go all the way down to $84.90, okay? I'm just doing the math in my head. I hope I'm not making mistakes here. I'm just throwing it out there, but it's pretty simple math. I think you can follow along. If I made a mistake, let me know. Okay, so That's where the break even is. So the stock can actually go down even through your put strike, and you can still end up with some profit, or your break even is, like I said, the put strike minus the credit received. Okay? On the call side, there is no break even. There's only winning trades. Well, unless you collect exactly $5, right? In that example of the 90 put, what did I say? Maybe I said 100, 105 call. I can't remember now. In that case, unless you collect exactly $5, yes, then there is a break even. But it's break even, and no matter how far up the stock goes, you're going to be at break even. All right. To the downside, the break even is the put strike minus the credit received. There is no break even to the upside, only winning results to the upside. Only possible loss is a downside move that exceeds the short put strike by more than the credit received. So do you see why this has such a high probability of winning? Because first of all, we're selling a put at the implied move, but we don't lose money unless the stock goes through the implied move by a substantial amount of money, the amount of money that we collected. And what did we learn as one of the main concepts of this, the basis of this strategy? 80% of stocks don't move beyond the implied move on the first trading day after an earnings event. So on that first trading day after an earnings event, and if the stock does go up and beyond the implied move, there's no loss up there. There's only one way to lose money. That would be an outside move, larger than the implied move, only if that move is to the downside. That's why this has such a high probability of winning. It's just common sense, folks. Now, usually we talk about how these trades set up and how they're profitable, and we focus on the winners. Before we focus on the winners, because there's so many of them, there is the occasional loser. Even with a 90+% probability of profit, there is going to be losing trades. A worst case scenario, Meta, previously Facebook, earnings date, February 2nd, 2022. Look at a chart just to get a perspective here. Here's a price chart at Thinkorswim. Meta. No, I think Meta. I think I can do that. Meta. Okay. So there's February 2nd, 2022, right there. A 26% one-day drop, almost 27% one-day drop in price. This trade, the SWIC trade, would have lost money. Let me show you. Let me show you a. Here we go. Hang on, I got. Hang on, I lost it. Where'd it go? Okay. Found it. All right, here we go. All right, so I used OSBTT, the Option Slam backtesting tool, okay? Available to insider members at the website. You can catalog your back trades, your back tests. Here's the trade using the weekly options on February 2nd, We use the options that expire February 4th, the front weeklies. Stock was trading at 323. The implied move was about 25 points. Would have brought you down to the 297. I could have done this with a 297.50. I did it with the 300. Doesn't make much difference. There's the short put, okay, right there. There's the short call, and then add the long call to create the short call spread, okay? And there is no fourth leg. There is no leg D. This is the SWIC. One trading day later, you collected $492.50 for this trade. Not quite the let's see, 345, 347.50. Yeah, so that's 250, and we collected $5, almost $5. Okay, so I played with this a couple different ways, so I don't remember. But anyway, here's where we're at. One day later, the P&L was down $5,687. Now I've got some adjustment ideas here, what to do with a losing trade. But this is a worst case scenario, so I don't want to just suggest to you that just because there's a 90% probability of profit means that there's no risk. There is risk, and the risk is pretty substantial. Let's go back to the PowerPoint. Meta earnings date 2/2/22. That's kind of an ominous number, or it will be to me in the future. A lot of those 3 6s they say is kind of an ominous number. Now 3 2s or 4 2s or 5 2s in this case becomes an ominous number to me. One day move down 26.39%. Stock has done almost nothing but go down ever since then. Refresher. There's that earnings date, and it just plummeted down after that earnings date. Yeah, it had a bounce back up, but that was it. It's been down ever since. Obviously down ever since. 2 ways to manage the losing trade. It's not the end of the world. And traders it's often said that you don't want to sell a naked put unless you are willing to take the stock. And why would you be willing to take the stock? Because in your belief system, the stock won't go down forever. It will eventually recover. It will come back. It might take some time, but you have faith in the company that it's not going to zero. It's not going to be Enron. There's 2 ways to manage this. If you know of a third way, let me know. You can take ownership of the stock and start selling covered calls. Okay? Well, if you believe in the company and they just had a bad earnings report, why not take the stock and then just start selling covered calls against it? Nickel and dime it, a little at a time, 1 week at a time, 1 month at a time, whatever the case may be. Sell out of the money calls and bring in a little premium each month against your ownership of the long call, against your ownership of the long stock. Excuse me. The other way to manage the trade is not take ownership of the stock, but instead roll out the short put to a further dated expiration. In other words, buy back that now in the money short put. You sold the short put. buy that back, but then resell that same strike in a further dated option. That's going to bring in a credit, right? Because when we sell options that are out further in time, they're always more expensive than options that are in close to time, right? So if in this example, let's go back to the example from OSBTT. Here's adjustment number 1 on this worst case scenario. Adjustment number 1 does what? It's going to buy back this 300 put. And let's take a look at it. Here it is. Long the 300 put that expires now in 1 day instead of 2 days. Notice the trade date is now, this is the second day. This is after I know I'm holding a losing trade. This first trade was the before the earnings announcement. The earnings announcement came out on February 2nd after the close. This trade is, I'm a loser. Well, I'm not a loser, but my trade is a loser, excuse me. My trade is a loser. And it's February 3rd, it's at the end of the day, and I'm in trouble, so what do? Now, I could have waited until the 4th. I could have waited until the next day to do this. But that there's reasons. The way the software works, there's reasons I do it this way, just because it's more realistic to do it this way. Okay, and without getting into that, let me just continue on. So now it's February 3rd. The trade is a loser. What do? I buy back that February 4th short put. See, I'm long, but I sell a further dated option at the same strike. See that? I sell that option. And I also sell a call. Okay? I also sell a call. Now, you don't have to sell the call, but it brings in just a little bit more premium. And why not sell it? It doesn't cost you any more margin to sell a call than having the margin that you assume by selling the put. Okay. So I collect $137 for that. Then what happens? We get out to 218. And here I did it the other way. I went all the way to 218. And where's the stock? It's way down here at 206. So that 300 put is still deep in the money. So what do? I just buy back that put. I did this wrong. Oh, no, I didn't. No, I did 318. Okay, so, and then I resell that put further out in time to March 18. And what happened to that 300 call from the previous trade? Well, it expired worthless, so I don't have to buy it back. That call that I sold expired worthless, so I don't have to buy it back. But I can sell another call another month out and bring in not much premium. But I'm nickel and diming my way back into and towards break even as the stock continues to plummet. I'm bringing in credit every month. And yes, I am tying up a substantial amount of margin doing it this way. Okay? The other way, you just tie up cash by assuming the stock, letting them put the stock to you. You just tie up cash. This way, I tie up margin, trading power. Okay? Either way, it's almost a wash. All right, so there's the worst case scenario. All right, let's go back to the PowerPoint. Roll out the put further dated expiration. You can also sell far out of the money calls for a little extra premium collection. And the call can even be at a lower strike than the put. Okay, so I'm not getting much for that out of the money call because it's so far out of the money. Okay, I could come down where I'm actually collecting a much more substantial amount of money to bring in more premium, but there is extra risk assumed. And I'm not going to get into the details of that because I just don't want to go down that rabbit hole right now. I'm going to get to more to managing winning trades and showing some examples of some recent trades, as well as evaluating some trades that we're going to have the opportunity to actually trade this strategy. So now we've got the worst case scenario out of the way. Let's move on to the 90% plus probability of dealing with a winning trade. Review of managing the losing trade. Close the trade, take the loss. That's one option. Okay, there's the third option that I told you guys. Is there another option? Yeah, you can take the loss. I personally am not one to jump at taking losses. I personally am looking for ways to avert losses, turn losing trades into winning trades, or otherwise avoid taking a loss on the trade. Take ownership of the stock and roll the strategy into a covered call situation, or roll down to collect more credit. Managing the losing trade. Okay, so so here's another adjustment that you can do before, if you want to, if there's some time. Let's say that there's more than one day left, right? If there's some time, you can roll down the call credit spread down closer to where price is actually trading to collect some more credit, giving you a little more room to the downside. Now, in that Facebook example, that wouldn't have helped much. Well, I don't know. I guess I should have run that scenario. It probably would have helped actually substantially. But okay, I didn't think of running that example. But let's move on. The short put can be rolled out in time to collect more premium. So we already just talked about that, and we added selling a call also. All right. You can also sell straddles, which is what I illustrated with the back test, at the original put strike, which does not increase margin but does improve the credit received. Okay. Now, some other adjustments to consider. More likely, most of these are going to be for a not for a winning trade. Let's talk about some other adjustments that you can consider. I think most of these are going to be for the winning trade. Close the trade by reversing the entry actions, buy back the short options, and sell the long options. Okay, so that's an adjustment. Closing the trade is an adjustment to your positions. Okay, so you can close the trade if you've got a trade, winner or loser. That's an option you have. A winning trade can be worked to bring in more credit. A winning trade can be, so I just talked about a losing trade can be worked to bring in more credit by rolling that call credit spread down. But what about a winning trade? Roll the put strike up. Okay, so the stock goes up after the earnings announcement. That put now has very little value. You sold it for the big bucks with the high premium and the high implied volatility. Volatility is now crushed. Price went in the right direction away from that short naked put. Now that put can be bought back for pennies. Why not buy it back for pennies and sell some put that's still out of the money, but has a lot more premium that you can let bleed as time passes as we approach expiration day. Roll up the short put strike for a credit, for another credit. So now you've just increased your credit on the original trade, and now your max profit is higher than it started out to be. How about that? This would be the example of a trade where the price either went the wrong direction or didn't go anywhere. If the price doesn't go anywhere, and we see that oftentimes where price just goes sideways after an earnings event. IV crushes, that's great for us in this trade. Premium dissolves, basically. Instant winner on your hands. And if you don't think price is going to go up in the next days between now and expiration day, whether you choose the front week weekly or the front month monthly, whether you choose an option that's going to expire in 2 or 3 days, or you choose an option that's going to expire in 2 or 3 weeks, you need to evaluate that and decide whether you hang on a second. Okay, sorry for the interruption. I'm back with you. Let's see. I lost my train of thought. Let's see. Where were we? Oh, the credit spread down. Okay, so you can. So if a stock goes sideways, a way to bring in more premium. Okay, and if you think the stock is not going to go anywhere between now and expiration day, whatever that, whether that's the front week weekly or the front month monthly, it doesn't matter. Your opinion is stock isn't going to move very much. It didn't move up on the news, and it's probably not going to move much between now and expiration day. You can do one or both of these. Roll the put strike up, roll the credit spread down, or do both. Bring in more premium for each motion. Or you can take on more risk by rolling the short leg of the credit spread down, leaving the long leg where it is. Only roll down the short leg. This will bring in a better credit for you, but it exposes you to more risk if the stock does indeed move to the upside. You know, I had a trader who sent me an email here last week, and I apologize I didn't get back to you yet. You're on my list to get back to return your email. But he took my Double Eagle workshop some years ago, and he said, you know, Marko, you ought to do a workshop on this single winged iron condor trade. You ought to do a workshop where you really dig in deep and dive, because I can't dive in real super deep in a 1 hour webinar, right? I can't explore every scenario and show examples of every scenario in a 1 hour webinar. But if we have a series of webinars, and I really spend a lot of time and effort putting together lots of examples and show actual real trades and et cetera, et cetera. So I'm thinking about that. So thanks for the suggestion. I'm thinking about putting on a workshop where it would be paid. You'd have to pay to attend it. It wouldn't be a lot of money, but you know, where we really dig in deep and take the deep dive into the SWIC, the single winged iron condor. Roll the short leg. Okay, let me get back to. So what else could we do? Adjustments to consider. Buy back the short call. What would that give us? If we got a winning trade, the stock went up, and it went up strong to the point where, and we think, we are of the opinion, the trader is of the opinion that this is going to have legs. This move is going to continue going up over the next X amount of days or weeks, whatever the case may be, depending on what expiration cycle you chose. This would be an extremely bullish mindset to buy back the short call, because what are you left with? Now you're left with a short naked put that's already super profitable. And you have a long call. Now, you can buy back that short call, and I would suggest that you don't, I would suggest you think about that and don't spend more than what you collected in the original credit for the trade, because if you spend more than what you originally collected, then you could turn a winning trade into a losing trade. Okay? So think about that before you jump and get super aggressive. Okay? But as a super aggressive move, this is an adjustment that you could consider if you think that, the earnings report came out, it was a good report, the conference call came through, the management had nothing but bullish things to say about the future and the outlook, and everything's rosy, and the market is in an uptrend. That's not the case right now, but but if all the ducks are in a row, that would be another adjustment to consider. Some recent SWIC trades, okay? Some recent SWIC trades. I actually took quite a few of these myself, and I'm happy to say that I have all winners. I haven't had to deal with a loser yet, okay? I didn't take all these trades, but I took many of them, okay? So let's look at some examples. We're probably going to run out of time here, but that's okay. I will go over time a little bit today because I want to show you some examples of recent trades, and I want to evaluate some potential trade setups for this week. Okay, so let's see where we start. Let's start with ADSK. We evaluated Cisco in detail in the last webinar. We evaluated Walmart, I think. Maybe, Lowe's for sure. We evaluated that one in the last webinar. So we won't revisit those. So let's look at some of these others. We don't have time. We don't have time to do them all. But let's look at ADSK to start with. Okay. So. Let's see, what is this? This is Meta. We don't need that anymore. Here is ADSK. Okay, so ADSK. All right. So notice the tab ADSK W for weekly, M for monthly, and then the updates on the monthly. I think I might have shown this in the last webinar. This trade. So here was the weekly trade, brought in $287 credit. Okay, this is selling the 195 put and then the 225, 227.50 credit spread on the call side. Brought in a total credit of $287. The stock, let's see, entry date. The very next day, one day later, this was profitable by 197.50. Okay, now I didn't follow this up to see what it was by the end of the week. Again, here, that's why I say maybe we do a workshop on this strategy so we can really follow everything through to all the final details. But let's look at the monthly trade, also placed on the same day, 11/22. and also only followed for a couple of days. Let's see, 22, 23, and then 28. Um, it doesn't even make sense, does it? 25, 26, 27, 28. Was there a holiday? I remember. Our data service provider, our data service provider was missing the day after Thanksgiving. We did get that backfilled. We did get that information. So on the next page, I think you'll see that there's another date in between here. That's what I think happened here. But anyway, let's see. Um, uh, so this is using the monthlies, and there's not much profit here, okay? And now update the results as of this morning. So I updated the results, 23. Yeah, see, there's the 25th. The 25th was missing out of our data, but then we contacted our vendor, and then they backfilled it in there. So, okay. So here you can see the profit was not that great on the 23rd. On the 25th, the profit jumped up. There was a maximum profit available at one point on 12/1, and then and here's a good example of if you don't take your profit when it's available, it could slip away. It could deteriorate. It could disappear altogether. Yes, that's possible. So managing your trade is really important. Managing winners is very important. Let's take a look at the price chart of Autodesk, right? Autodesk. ADSK. Okay. We'll zoom in on this zone this time. There's the earnings date. What happened to price? It went down. But we had a winner of a trade so far. Even here, with price substantially below where it was, we're still up 250 bucks as of this morning. Here we were up about 350 bucks, approximately, just from memory, from just looking at that OSBTT report. Okay, so that's that. Let's move on to another stock. NVIDIA. This one I did do. I actually did trade this. Let's take a look if I took any screenshots. Pretty sure I did. Okay, so ADSK. So when did I take this screenshot? Sometimes I don't take them timely, and I don't get them to them until the next day. So this looks like when I actually took the trade. That's what this looks like. Because look, price is right in the middle between the put strike and the call strike. Okay, the short put and the short call. Price is right in the middle. You see there's a little bit of a credit even if price overshoots above. Collected $277, and then let's see what's the next slide. The next slide is showing an options chain. I maybe was showing, let's see, what's the date of this slide? 11/16, and the previous slide was also 11/16. So I'm showing I think the purpose of this slide was to show the implied volatility, but then did I show it on the next day? Let's take the, yeah, I neglected to show it the next day to show how it crushed. But there's the next day P&L. You see, price didn't go anywhere. Price went nowhere. And here we are the very next day. Okay? Price went nowhere. And I don't know if I adjusted this trade or if I just don't remember. But this would be a good example of you could roll up the short put, you know, for example, up to the 152 strike. You could roll down the short call spread, maybe down to the 167 or 166 area. Okay? So those are some opportunities. I don't know if I did any of that stuff. Let's take a look at the next slide. Let's see. Short the 175 call. Oh, okay. What I did is I sold the 175 call for a nickel. Okay. Now, I don't know if I did that or not. I can't remember. I'd have to go look at my trade log. But that's another adjustment that I didn't talk about in the PowerPoint. You can salvage if you don't think you need that protection up here anymore. Okay. If you feel like, oh yeah, this stock isn't going anywhere. That earnings report was kind of a, do nothing, go nowhere earnings report. The the conference call was kind of dead in the water too. If you don't feel that you need that protection up there anymore, you could just sell that. You're not going to get much money for it, but $5 is $5. Pays for some commissions, right? Let's go to another. Let's see if there's no. That's it. That's all the slides on that one. Let's see. Who else do I have? We talked about Cisco at length. Deere, I don't know. Do we have much on Deere? I don't think I traded this one. Let's see. There's the trade the day after. Okay, that's okay. And this one I actually toyed with some adjustments. Let's see. Sell the 410 put and buy the 385. Oh, okay. So okay, let's. Well, wait, where's my original? Oh, I see. They're out of order here. Okay, the original trade is this. This is the original trade. Sell the 385 put, and then sell the 445, 450 call spread. Okay, and then stock goes up. Okay, stock goes up. I didn't. Here's the original trade, but I didn't take a picture of it when price was down here in the middle. Stock goes up after the earnings report. Then we go. Then this slide shows an example of rolling the put up. Buy back the 385 and sell the 410, bringing in another $1.78 of credit. Okay, so maximum profit on this trade was 560. It's threatening to go through to the upside. So to protect myself from further upside move and only having a break-even trade or a $60 profit trade, I should say, a $60 profit trade, I changed that into I add $178 more potential for profit above the $60 by rolling this up. Now, does that take on more risk? Well, it doesn't take on more risk, but it moves risk closer to where price is trading. My risk was way down here at 385. I've just moved my risk up here to 410 by doing this. Okay, so I'm just showing some examples of how these adjustments affect your situation. All right, let's see. Do I have another slide on this one? There's the original trade, and then there's the. Okay, so here's another adjustment idea. Okay, and notice that this $1.86 is not checkmarked. So this adjustment is not being represented. So here we're in this adjustment idea, we're still short the 385. We did not roll that up. Instead, what did I do here? I bought the 445 back. Okay, here's another adjustment I did not talk about in the PowerPoint. Okay, I did not mention this one in the PowerPoint. Again, another reason to actually have a workshop. That was Paul. I think Paul also goes by the name of James, but I think I know him primarily by Paul, the guy who suggested that I do a workshop. So I'm seriously thinking about that, because the more I look at all of these adjustments and all these ideas, the more I realize how I can't fit it all into, 1 or 2 short webinars. So here's another adjustment idea. If you're bullish the stock, rather than roll that put up to the 410, don't do this, uncheck mark. Instead, if I'm bullish the stock, how about I buy back the 445 short call? See, I'm short that call. But rather than just buy it back, just resell it out at 455. So I'm going to convert this 445, 450 short put credit, short call credit spread into a long call debit spread on the 445, long the 450. I'll be long the 450, and then I roll this 445 up to the 455. This costs me $478. Okay? It costs $478, but it increases the potential for profit up here if price is to exceed the 455. So if I'm super bullish and I think price is going to continue moving up after this positive earnings event and conference call, this is another aggressive bullish move. What's the worst thing that could happen? I'm wrong and price goes down, and then I still end up with a positive winning trade, although I would have given up, some of the potential profits that were already there. All right, so that's enough on that one. Let's see, who else do we have? DE, HD, Walmart. Running really out of time. I'm going to skip some of these. There's some really good examples here, but I'm going to go to Best Buy because I know that is one that I actually did trade. So let's look at that one. Let's see, do I have any slides open? I don't think so. All right, so hopefully these are in order. This looks like the day I put the trade on. $1.02 credit, okay? A typical SWIC trade, single winged iron condor, SWIC for short. $1.02 credit. Next slide. Now, this is a great example of price zoomed up and it went through my call strike, my short call strike, and it went through my long call strike as well. Does that mean I only can make the little bit of $2 profit? No, it doesn't mean that. Not yet. It will mean that if I hold it all the way to expiration day. But if I manage this trade right now, you see that purple line? It's $44 of profit. If I manage this trade right now, it's $44 of profit. If I hold this until the options expire, it will only become $2 of profit. Are you with me so far? A few questions in the chat box, and I'm sorry I don't have time to get to them because we haven't even looked at. We're already past our 1 hour time slot, and we haven't even looked at upcoming trades yet. So I'm not going to be able to get to questions. More evidence that I need to put on a workshop about this strategy. Let's go forward in slides here, and then I'm not going to show any more historical trades. We'll look at live upcoming trades. We're just out of time for looking at examples of past trades. I have lots of good examples, but I just don't have time. So here's some adjustment ideas. Here is buying back the short 77 call and selling the 78 call. So closing the call credit spread. And let's see. This isn't right. This says 73. This should be the 63. So this would have been actually a better credit than what is being illustrated here. I should have actually bought back the 63, not the 73. Oh, wait a minute. No, that's not what this is. This is a sell the 80 call, sell the 73 put. Oh, sell a strangle around where price is currently trading. Yet another adjustment that I did not illustrate or mention in the PowerPoint. So the PowerPoint that I provided left out a bunch of possible adjustments that that I'm illustrating now in these screenshots. Okay, so let's see. This is not what I did though. I was in this trade. I locked in profit on this trade. Here's another adjustment. Yet another adjustment. Here's the original trade, and then buy back the 77, sell the 79. So again, I illustrated this adjustment. I did not do this either, but it's something that I was just illustrating. And this gives you, increases your potential for profit if the stock keeps going up. Yet if the stock pulls back, even if it pulls back a very, very, very long way, you're still profitable. Okay? Not very profitable, but profitable. Okay? And then let's see, this is what I actually did. I closed the trade for $59 profit. Okay, so enough of that. All right, let's go now to optionslam.com, my favorite website of all time. And let's go to the stock screener. We'll use my generic screening just to see who's got earnings coming up within 1 week from today with some very minimal requirements as to filters to screen out so that we don't get hundreds of stocks here. We want to screen out stocks that we're really not interested in. So this is stocks that trade 2 million, let's see, yeah, 2 million volume. You know, you could lower that criteria down. These are stocks that trade over $20. These are stocks that have EVRs of over 1. Okay, so here they are, stocks that are going to be reporting within the week. Okay, so what I'm gonna skip over these two first ones because I don't even know what those companies are. Not familiar with those. They don't ring a bell to me. There's GameStop. Sure, I want to own GameStop. You know, one of the things you want to think about is this a stock that I would be willing to own if all hell breaks loose, right? And is this a stock that I'd want to assume ownership of, let them put the stock to me in the case of selling a naked put, and then convert this into a covered call strategy? Personally, I've never traded GameStop. I don't think I've ever traded it. So I'm not that familiar with it. I'm not sure that I want to own it. I'm going to skip past that one. AVGO, kind of a high flyer. AVGO, no, it only has an EVR of 1.7 nowadays. Let's take a look at AVGO. It's a high flyer in the way that it's a high price stock, $530. So it's going to tie up a lot of margin to sell a naked put on this stock, okay? Because it's a high price stock. Let's try Chewy, a lower price stock. We're out of time. Costco would be one that I would do this strategy on for sure because I wouldn't mind owning Costco. In fact, I already own Costco. I wouldn't mind owning more, especially at a discounted price. So let's look at DocuSign is also one that I would consider doing. So these three, AVGO, Chewy, Costco, Docu, those four, and Oracle, those are all ones that I would personally consider doing this strategy on. Now, I'm not saying that I would do it. I'd have to evaluate each one individually, and let's evaluate Chewy to start with right now. All right, so here's Chewy. We'll go to open that link in a new tab. Here's Chewy. And we'll go to the implied move weekly page, and we'll see that the current implied move is about $5.20. Oh, no, I'm sorry. That's the previous quarter. For implied move weekly, we have to take a look up here. It's 13.37%, and the implied move monthly is 15.59%. Let's take a look first at the weekly and see if this trade is doable with the weeklies. That's what I usually do is I look at the weekly. So we got about 13.4%. Okay, so let's go to the CHWY. When is the earnings event on that one? It's in a couple days, so it's too soon to put this trade on. I would not put this trade on until December 8th because they report after the close on December 8th. So I would wait until later in the afternoon on December 8th to initiate this trade, because it's only then where I'll know where price is, and it's only then that I'll know what the appropriate strikes are. So what we'll do today is we'll just pretend that today is the earnings date. It is not the earnings date. We're going to pretend that it is. If today were the earnings day, what would this trade look like? Oh, I did this before session. So here it is. Good. That gives us time to set up another one. Here's what it would look like if the earnings date was today. We could set up this trade. It would bring in $1.30 credit. It would give us downside potential all the way down to 35.70, even though we're selling the 37. The 37 minus $1.30 is $5. Is the 35.70 is the break even, and there is no break even to the upside, only winning trades to the upside. So there's the Chewy trade. Yes, I would take this trade. I think this trade has potential. Let's take a look. What Chewy had up move after two earnings ago. After the last earnings event, it was a down move. We should probably back test that and see how that would have panned out. But I can see even if this would have lost money, even if this trade would have lost money, I could have rolled this trade forward in time, and it would now have become a winner. I could have turned this, even if this was a loser, which I'm not convinced that it was. In fact, I don't think it was. If you would have done this trade, the SWIC, on this earnings date, this would have turned out to be, I don't know, if you did the front week weekly, it might have been a loser here. I'd have to back test that. I did not back test it. But even if that was a loser, I could have rolled this out into time, and by now it would be a winning trade for sure, Okay, and now would I do this trade again at these prices? Well, we've been in a bear market. The market's under pressure. The downturn in this earnings event was not terrible, and it did overcome that. The price of the stock overcame that down move from the last earnings event. I think I might take a chance on Chewy. Looks a little risky, but let's look at another one. Let's say we got to go to our. Who else did we have? Costco. Well, Costco is kind of an expensive stock. That's going to cost a substantial amount of margin, but and Docu. How much time do we have? Let's see if we can look at two more. Let's see if we can look at Costco and Docu. Docu's probably more risky than Oracle. Oracle's just been around longer. It's got more, it's got a much larger market capitalization. I assume. Let's see what's the market cap on Oracle. we would have to go, let's go look at that. Let's open that in a new tab. Oracle, market cap, 224 billion. 224 billion. Docu, open that in a new tab. And market cap only 9 billion. So 224 billion versus 9 billion. So Oracle obviously way higher market capitalization than Docu. Docu therefore subject to much quicker moves. Okay, Oracle is not the kind of stock that is going to be able to. You're not going to be able to move the needle on that one as easily as you will be able to move the needle on a Docu sign. So I would equate that to more risk in Docu than Oracle, although I guess that could be debated on other metrics. So let's look at Costco. Let's see, let's go Costco and open that in a new tab, and we'll go to implied move weekly is 4.4%. Let's take a look. COST and analyze Costco. Get rid of whatever that is. We'll have to hide my current position. Okay, there we go. So now we're to a clean screen. And let's see, Costco, let's look at the weeklies. I think I said 4.4%, right? So we'll go to the at the money, which is $480. 480 times 4.4% is a $21 move. So let's go $20 down from 480. That would be the 460. We'll sell the 460. And let's go $20 up from 480 to 500. And we'll control key, sell the 500 and buy the 502.50. Brings in a credit of $3.19. There's the trade. That's it. My credit is bigger than the $2.50 spread. Therefore, I'm collecting more money than this spread can possibly lose by itself. And in risk profile, we're going to have to zoom in on that so we can see the risk profile. Let's zoom in on that. There's the trade. Let's set the standard deviations up to the appropriate December 9th, which is this Friday, or technically we could say the 10th because options don't really expire until Saturday morning. Then all extrinsic premium is dissolved by then. Whereas at the end of the day, Friday, there is still those market makers, you know, those pesky market makers, they hang on to a little bit of extrinsic premium, even though they don't deserve it at 5 minutes before the close on expiration day. So let's see, there we go. There's our trade setup. Looks good. Takes a substantial amount of now this is portfolio margin. So your margin is probably, if you're in a Reg T margin, your margin is going to be much more substantial than this. This is portfolio margin. I don't know, Reg T margin would probably be 20% of the price. Reg T margin is probably 20% of $48,000. Let me see. Well, 48,000 times 20% is $9,600. My guess is that Reg T margin would be around $9,600 on this trade. That's my guess. One of you guys can model that in, and if you've got a Reg T account, let me know if I was close on that. All right, well, let's see. We're 15 minutes over time here. Did we cover, let's see, did we cover those stocks that I said we were going to cover? Let's go see. I said Chewy, Costco. Let's do Oracle. Let's see if Oracle plays out, and then we'll have to call it a day. Okay. I think we have a tab up here for Oracle. Okay, Oracle, there we go. 7.62 on the weeklies. You can do the monthlies. I often do the monthlies too. You're going to have different strikes doing the monthlies because there's a wider implied move. Okay? A bigger implied move takes us to strikes that are further out of the money. Plain and simple. Let's look at the 7.6% implied move on Oracle. ORCL. Get rid of whatever that is, and we will go to add simulated trades. We're looking at the front week weeklies. Stock is trading at $78. $78 times, again, these stocks are not reporting today. So we're pretending that these, let me just restate that. We'll go back to this report here, and we'll see that these stocks are not reporting. Costco doesn't report till the 8th. Chewy doesn't report till the 8th. And Oracle doesn't report until the 12th. That's next week. So I'm not even looking at the right week right now. So that I'm not even looking at the right week right now. So I need to look at the 16th. That would be the front week weekly for Oracle, okay? But it's way too soon. It's a week too early to put this on. All right, so the implied move was Oracle. The Oracle right here, 7.6%. Stocks at 78 times 7.6% is a $6 move. So 78 minus $6 generically takes us down to sell the 72, brings in about $87. 78 plus $6 brings us up to the 84. Sell the 84 by the 85, brings in $1.10 credit. Nice setup, 10 cents wider than the call spread. 84 to 85 is $1 wide. I'm bringing in more than $1. Therefore, I have a bona fide SWIC trade designed that can only lose money in a substantial move downwards. Let's free up these price slices and delete this one. And there we go. That's what that trade looks like. Okay, there's a trade that that I would definitely consider taking. Just for reference, let's see where Oracle is. It's been on a tear lately. So I'd be might think twice about getting super bullish by selling a naked put on this at these short-term high prices right at a previous resistance level. I might think twice about this based on some quick technical analysis, okay? I'd rather do this with price somewhere in the middle here or even towards the low end possibly. Okay, so there you go, folks. The SWIC trade. Hope you enjoyed the webinar session. I apologize for not being able to answer those questions. If I some of those questions, it looks like I did answer, just because. And if you still have questions, feel free to email me, optionslam.com@gmail.com. And we will be having another webinar next week. Topics, the topic is wide open. Please shoot me your suggestions for a topic for next week's webinar. I have not settled on a topic for next week's webinar. All right. With that said, I'll wish you goodbye for now and good trading.